The next problem under NPV method, wherein the investments done in the projects X and Y are different. In the previous one we have done project 1 and 2, the investment is same. In that, how to choose. Here project X and Y are there, but the investment is different. How to choose, we have to check it out. So here in this problem we have calculate NPV of two projects and suggest which project should be accepted at 11%. So I have taken PV at 11% discount rate, and also calculate profitability index. We'll come to that part B later. You have three columns in the problem given: particulars, project X and project Y. So initial investment 20,000 and 30,000. So project X is 20,000 investment and project Y is 30,000 investment. Investment is nothing but the virtual investment or outflow. So when we have a format like this, easily we can fill also, but you have to read and understand what working to be done. Next, estimated life 5 years for both. Scrap value is 2,000 and 4,000. So what is scrap value? We have to understand here. Scrap value is the money that will be received at the end of the life of the asset. The life is here, for example, X project is 5 years. So project X closes at 5 years. Project X will be disposed, that means will be sold. So when we sell project X, the money received will be scrap value, that is 2,000. So 2,000 rupees will be received at the end of 5 years. Similarly, project Y, scrap value is 4,000, that will be received at the end of 5 years. 5 years is not common for everything. We have to see the life. The life is 6 years, at the end of 6 years. At the end of 5 years means at the end of 5 years. We have to check and understand. So let me get into the factors here. I have taken PV at 11%. I have done the calculation and I have put it over here. Next we have to see the cash inflow after tax before depreciation. We want for this cash inflow is after tax before depreciation only. No need to change. When you are reading the problem, you have to read very carefully whether the cash inflows are suitable for NPV method or not. For NPV method, it is after tax and before depreciation. So underline that before depreciation, you will understand the cash inflow given here is the proper one, no need to change. So let me get into the cash inflow. First year for project X, 5,000. Second year, 10,000. Again 10,000 for third year. 3,000 for fourth year, 3,000 for fifth year. So after that, you are going to add up the scrap value at the end of 5 years. So at the end of 5 years, scrap value is 2,000 rupees. So I have repeated the same PV factor for the 11% for 5 years. Because at the end of 5 years, the PV factor also remains same. Some people add this 2,000 to 3,000 and make it as 5,000. That is also fine, not to worry. But I have taken separately so we can remember that scrap value to be taken therein and we have to take it as a cash inflow. It will remain as. Then for project Y, the amounts 20,000, 10,000, 10,000 again, 3,000. 6,000 and the scrap value again, scrap value for 5th year, 4,000 for project Y. So we have to take that without forgetting. That is the specialty of this problem. Scrap value is the money received at the end of the life of the asset. It is a cash inflow. So let us go earlier as we have done. Multiply PV factor into cash inflow. Find the PV of cash inflow. So 5,000 into PV factor, 10,000 into PV factor, like that. Same like earlier problems. The method remains the same. So if you add all the PV factors, 24,864 total PV of cash inflow after adding scrap less total cash outflow. 20,000 is the investment. So profit is 4,864. Next we move on to the project Y. Cash inflow multiplied by PV factor. PV factor is same, 11% for X also, 11% for Y also. So if you multiply the PV of cash inflow, I have calculated, I am copying the same here. So you can add all the PV of CIs, 41,344. So it is going to be 11,344 is the NPV. So if you look at this, NPV of Y is more, so Y is preferable according to this. We will do the PV, it is the PI, profitability index for X, profitability index for Y, NPV 4864, original investment 20,000 multiplied by 100. So for the Y, the NPV is 11,344 and investment is 30,000 multiplied by 100. So for this X you get 24.32%. For Y you are going to get 37.81%. So this is the one which is going to tell true profit, not the NPV, because NPV is not the one for consideration because investment is different. So we cannot prefer so easily. So we have to prefer based on profitability index percentage. So based on PI, project Y is preferred because of higher PI compared to project X. So based on PI is the best way to choose because the investment amount is different. Investment amount is same, NPV we can take it. If investment amount is different, we have to take based on PI. But even if you want to do on NPV, the best one is the higher NPV is the one to be selected there.